Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Daryl Thomas, and today we have the pleasure of interviewing who I consider a friend, Josh Young of Bison Interests. How you doing today, Josh?
Great. How are you?
Man, I'm doing okay. You know, the markets have been very, very volatile. Looking at my portfolio, it's going vroom, 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 vroom. It's just like a roller coaster. So that's been kind of interesting, and I think I'm not new to volatility, but I think I am new to investing while the U.S. is in the middle of a conflict of this nature, and so that's something that's new for my experience as an investor.
Yeah, well, we named our firm Bison Interests because the bison's the only animal that when there's a storm, it faces into it and it gets through it safer and faster. So there's been a storm in oil and gas for many years, mostly to the downside, unfortunately. And so sadly, I'd say this is maybe more the norm for oil and gas than the exception.
Yes. So let's just dive in right in. So there's um, to my understanding, there's been some major structural damage to the supply of energy, oil and gas. I think there's even talk about fertilizer. Much of it is related to the Strait of Hormuz, but also part of it is like the gas fields and some of the infrastructure that have been blown up in the middle of this conflict. So I just want to get your assessment on like how bad is this for the global economy? I mean, many of these nations are reliant on this energy, and so just curious in your perspective there.
Yeah, there's a little bit of risk with this that depending on someone when someone's watching this, there's a binary nature to this conflict where to the extent that there's a peaceful resolution, we could see oil and gas supplies back on the market and a resumption of supply leading to very significant changes in prices and perceptions very quickly. And so there is sort of this binary nature. There is a significant amount of oil production offline, oil supplies that are disrupted, and natural gas supplies, mostly from the Gulf, the Persian Gulf region, but also there's a couple million barrels a day of oil offline right now from Russian oil exports as Ukraine has struck Russian oil export facilities. Concurrently with what's happening in the Persian Gulf. I think the thing I would highlight is that things are actually they're not that bad, and they could get worse to the extent that this conflict goes for many months. But the oddest thing to me has been that the folks that got this whole thing completely wrong, who were bearish oil, forecasting a glut that didn't happen and that wasn't there ahead of this war, have now sort of panicked, it looks like, and are talking about $250 WTI, which is sort of where I thought oil would get to at the end of a cycle after productivity declines, after sort of shale depletion and various other factors that haven't played out yet. And so I think it's sort of easy if you thought oil was going to be at 50 or 40 or whatever this year and you were wrong all year and then this happens. I think it's really easy to sort of panic and flip and start sort of getting on TV and yelling and so on, and a number of media channels I think are doing that too. And I think it's important to sort of be steadfast and careful. And so I
Hmm.
think we should see WTI oil probably should be over $100 right now, but it shouldn't be 200. And I think that the global economic damage, at least so far, should be moderate at most. And if this conflict extends for a number of months and this disruption extends for many months, then perhaps we'll get into a territory where there's significant economic disruption. But I mean, my message would be don't panic, and to be very careful of these sort of panicky responses by folks who are completely wrong about the whole oil market setup, both in terms of there being a super glut or whatever, and in terms of just ignoring oil geopolitical risk, which I've been guilty of many things, but not that in my assessment of oil markets in the last few years.
Yeah, yeah. Thanks for sharing that. So with some of the like gas and oil fields and some of the the damage that has been done to some of this infrastructure over in the Middle East. I'm kind of wondering, like, okay, it seems like it took, years, maybe even a decade to build that stuff, to build that infrastructure for the trade and such. And, and much of it's destroyed. I don't know the extent to like how bad it is, from your perspective. You're saying it's not too bad. It's moderately, at most, going to have some moderate impacts. Uh, like, how long is it going to take to rebuild this? Like, if this stuff just keeps getting like destroyed, like, how long is that going to take?
Well, it's always surprising how refineries have these fires and explosions and chemical plants and so on, and then you'll see in the news that they're online next week or next month or something. So I think there's a certain amount of replacement equipment and replacement expertise just because there is this tendency for refineries, which are inherently very combustible and do unfortunately have a lot of accidents. They just seem to be quite resilient, and the folks that manage them, own them, and so on tend to be quite capable at bringing stuff back on pretty fast. I mean, I would look to some of the most complicated equipment in the world for oil and gas that was attacked at Abqaiq in Saudi Arabia in 2019, and there was almost no production disruption. There was maybe a month of disruption for two of these facilities that were essentially irreplaceable, custom built, these separation spheres. And honestly, I don't remember exactly what they do. I just know there's a small number of them and they're ultra expensive and take forever to fix. And so there's been one or two things like that that have been damaged, like Qatar's LNG facility. They have one or two of those sorts of things that have been impacted, and there may be some small percentage of LNG offline for a long time. But so far, despite all the pictures and all the excitement, in my estimate, the biggest thing that's going to take time to normalize out is just the tankers that have been sitting there for so long on both sides of the Strait of Hormuz, trying to fix the sort of building air pocket of shipments that would have gone that didn't, and then addressing the backlog of oil that's been produced and needs to get transported, and fields that have been shut in that for the most part it looks like should be able to, based on the way they've been shut in, should be able to come on pretty easily. So it may be, let's say, a month to 2 months in terms of normalization of oil flows from tankers, from these export facilities. I actually think that's probably the biggest source of future disruption, to the extent that the conflict let's say it stopped today. That would be sort of the biggest delay in terms of the bulk of the volumes of oil exports, rather than some of the infrastructure that, it looks intense in pictures and people get on TV and wave their arms and stuff. But the reality is that much of that stuff is, for the most part, either repairable rather quickly or replaceable, or just not that key to actually getting oil produced, processed, and on the boat to wherever it needs to
Hmm.
go.
Okay, yeah, that's helpful to know. I did not know that at all. It looks kind of grim. I'm like, wow, like it looks like this is pretty intense. The so will nations have to do some, like, while this is continuing on, is there going to have to be some rerouting of some sorts? I know that Japan is a big oil importer, and some of these other nations. I think even I saw something earlier about the Philippines, and they're having some extreme gas increase in the gas price increase and such. And so, what does like the rerouting look like or whatnot? I mean, the political pretty much sentiment is like, okay, this needs to be resolved like soon, because they're the damage that could happen is continued to like build and such. And so, but what if it isn't resolved soon? Like, I'm kind of curious what that looks like for other nations.
Yeah, again, from what I can tell, it seems like there's sort of the same folks that were telling us about how there was doom because there was this massive oversupply that didn't
Yeah.
exist are now telling us that there's doom because there's a massive undersupply, and pointing to very specific places where they had specific supply chain challenges around the Strait of Hormuz being effectively blocked. And so I just it's just not that bad yet. And there are specific spots that have had shortages in specific refined products. But if you look at the actual impact of things, it looks like the biggest physical impact so far is China blocking the refined product exports. And if you
Hmm.
think about it for a second, China supposedly has over 1 billion barrels of oil in their strategic petroleum reserves and in their commercial storage facilities, and they have plenty of excess refining capacity with all these teapot refiners and major state refiners. They've been historically a pretty large refined product exporter. It's a big profit center. It's not like their economy can afford to not absorb these large refining export profits. And so to me, it actually looks sort of similar to, the various news outlets bringing on people sort of screaming doom and economic collapse. It actually looks sort of political and oriented to try to force a preempt essentially the end of this conflict earlier than would be called for from a sort of military and political and strategic perspective. So when you realize that, as soon as you see it, it all makes sense. It's like, hey, okay, the guy that said that oil was going to be 40 this year is now saying it's going to be 300. Okay, well,
Hmm.
he just really hates this, the US political party in charge and the person in charge and really doesn't
Yeah.
want them to be successful. And as soon as you process that, it's like, okay, yeah, there's this big story about this one spot in the world where there's one refined product that's missing. And oh, hey, it's not actually that they even imported oil, it's that they aren't able to import jet fuel because China stopped exporting it to them. Or, in Australia, China stopped exporting diesel to them, which is bizarre and is clearly political in the sense that China imports all kinds of commodities from Australia and needs Australia to have diesel in order to import iron ore, various other
Hmm.
essential commodities to the Chinese economy. It's very clearly, it looks like political and strategic for them to withhold those diesel exports, especially considering the huge quantities of oil in storage that China claims.
Circa 2020, we pivoted the entire company, turned on its head, brought in new management, George B., our CEO, who's built gold mines all over the planet, and we focused in on CK, copper cake. It was not reliant on drill holes and discoveries. We can go through this process, engineering, permitting, get towards a development stage asset. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
Yeah, I saw the headline about that China halting diesel exports and such, and then I was just trying to do a little bit of research in terms of like, okay, well, how much diesel do they export, or refine and export and such, and from what I was reading, it seemed like it wasn't that much, but I'm not sure. Like, I'm not an expert in this, so I'm not sure how impactful that is. But so you're saying that China halting these exports, that's having some major impacts on some of the nearby nations like Australia, and are there other nations that are being impacted by this as well? I'm sure.
Yeah, I mean, you see it in the news. So I think there was Philippines. I can't remember if it was gasoline or diesel, and then there was one country or two countries where there was a jet fuel squeeze, and jet fuel prices went up to $250 a barrel or so, and the margins for refining went up over $100 a barrel. It looked like for refining jet fuel. So yeah, you saw like really specific markets with specific impacts, and the reality is that you don't need to withhold huge amounts of refined products in order to have a big impact. You just need to withhold a little more than they were going to use otherwise. And because oil and oil product demand is so price inelastic, if you're China and you undersupply the Philippines by, let's say, 20,000 barrels a day of jet fuel, within a week you can have a panic because you're running out of jet fuel. They have to start canceling flights in order to, they have whatever reserves they had, but it's hard to store certain refined products for very long. And in many cases, unfortunately, a lot of countries believed this story that they were told on this super glut and so on, and they didn't learn the lessons from the COVID era in terms of physically restocking and having an abundant amount of various supplies in storage in case of supply chain disruption. And so we're seeing sort of the folks that should have, I think, in my view, incorporated those lessons and built sort of more robust supply chains and deeper amounts of storage and maybe more local refining capacity suffer the most. But again, it does look more political to me and less fundamental. I'm not saying that if the Strait of Hormuz didn't open for a year, that there wouldn't be a huge economic disruption and price impact. But we're only a few weeks in at this point. Almost all of this looks like it's sort of political and distorted. It reminds me a lot of Liz Truss when she became prime minister and there was this organized campaign to get her kicked out. And so she had what people claimed at the time was a really irresponsible budget and economic plan. It was a very conservative plan. It actually, to me, seemed quite reasonable. And you saw a run on the gilt, the UK essentially treasury bonds, to the point where she and all these like doomy news articles, and then so she's out, and then you end up with a far left prime minister in the UK who's running a much bigger deficit with a much worse economic plan, and you have the treasuries. I think the gilt's actually traded even worse after Starmer came in than Liz Truss. And I'm not British. It's just I'm an economist, and I watch this with awe in terms of the media impact on sort of the perception of reality. And so, there wasn't a crisis, but there was a crisis that was almost essentially engineered through a combination of various countries, central banks, and their sort of bank responses to this perceived crisis. And there were a lot of these weird news stories. And again, you're seeing that here, in my view, where it is big, but it's not that big yet. And because it's not that big yet, the extreme reaction seems more driven by headlines and then more driven by withholding of supplies by key participants who have a stake in this, right? China is allied with Iran. They have a major political and strategic stake in keeping the current regime in Iran in place. And so withholding these refined product exports strategically, tactically, withholding in certain spots where it's most likely to end up in the news, where there's these big price chart movements and big 3-alarm news articles and supposed commodity experts and whatever. It's brilliant, right? But also a little evil and seemed worth speaking out pretty directly on. Because again, there's no reason right now to panic. There's potential risk in the future if this continues for a very long time, but there's no reason, in my view, to expect that this will necessarily last that long. And the folks involved from a political perspective are telling you that it's not going to last very long. So again, are they lying? Probably. Politicians lie all the time. I'm not taking sides on this, but they're telling you that they're aware of this issue, which means that they're going to try to resolve it at a point where there hasn't been catastrophic global economic damage. And again, just the media just keeps looking forward, and then you have these sort of engineered squeezes and engineered shortages that are, again, causing a lot of pain in certain spots to certain people, but it's not this global panic. It's not collapsing economies or anything like that. And we're very, very far from that. And then just the last point, the economic intensity to oil prices globally is way lower than it was in the 1970s, when there was real economic slowdown from insufficient oil supplies. And so the current disruption is larger, but also oil and storage is much larger right now, fortunately. And the economic intensity, just think about how efficient your car is. Many cars in the 1970s, they would drive 10 or 15 miles per gallon. These days, you might get 40 miles per gallon. Some people drive electric vehicles, they'll drive hybrids. There's just way more fuel efficiency, which allows for a much smaller impact. And then we're also a lot wealthier globally, so there's much less impact because we can absorb it a lot better relative to our economic activity and relative to savings and so on.
Yeah. Thanks for sharing that. I mean, there's a lot of smoke and mirrors. There's a lot of competition for competing narratives and such. It's like it's chaos, man. I mean, we see this in the markets, right? We see, like I mentioned earlier, it's just been up, down, up, down, up, down. It's like, wow, when you see these narratives that are competing and it's messing with investor psychology, like. I think many people are like, what do I do? I'm curious in your thoughts on this. Could this lead to like future stockpiling, more stockpiling, refilling of oil reserves and such. I know the our SPR was drawn down significantly under Biden. I think it started to refill a little bit, but is this like, do you think this is waking or will wake nations up to like, okay, we need to make sure we got, more emergency supplies on hand? I think Japan has 250 days of oil supply or such. And so I'm kind of curious on if you have any thoughts on that front.
Yeah, I mean, so two things. So one, unfortunately, probably not. I'm shocked. I thought that folks would have much larger inventories of a bunch of different necessary goods, both finished and unfinished, on the back end of COVID, and you saw none of that. You just saw sort of a full resumption of normalcy, and then of sort of the moves towards efficiency, which really just means sort of very brittle, thin supply chains, unfortunately, after COVID. Hopefully that changes after this, but unfortunately, the reality is, I think, that we're most likely to end up sort of back where we were because of a lot of different economic and political pressures. And then just because we're talking about the SPR, there was, again, this sort of wild narrative that releasing the SPR would do nothing. And it was just completely wrong. It was observably wrong. It's like, hey, your house is burning down. Don't try putting water on the fire. Like, don't spray the hose on the fire. Of course you spray the hose. Is it going to be enough to put out the fire? Maybe. Maybe not, right? We'll see sort of how big is the fire, what else is going on. You should call the firefighters, but you should also, if you're able to, if you have a fire extinguisher, if you have a hose and you're able to safely apply the fire extinguisher or the hose on the fire, and it's just a normal fire, it's not a grease fire or whatever, you should certainly apply that, right? Because why not? It's a physical aspect that could slow the spread of it. It could potentially put out the fire. And so similarly, this SPR release, the media conclusion before it even started was, oh, this can't work. It won't do anything. It's dumb and bad. But if you have a 12 million barrel a day disruption and you release 2 million barrels a day, well, you've taken a 12 million barrel a day disruption and moved it down to 10. Maybe you were overcounting. Maybe it was 8 million barrels a day and you moved it down to 6. We'll see, right? There's a lot of different numbers, and it's actually quite difficult to track down the precise amount of supply disruption. But you know for sure that if you're releasing 2 million barrels a day globally from the US and Japan and other strategic petroleum reserves, you know that that is cutting into the total supply disruption. You're adding to the supply. And in the countries that are releasing it, it suppresses the local price for oil. And so both of those are net positives. And again, my assessment of this is that the media outlets that are so ultra anti-war and anti-Trump and so on, this is just another tool to say, oh, there's nothing to do, therefore you must end the war, which again, that's a political calculus. I'm not weighing in on the war. I'm just observing the sort of weird sort of media narrative around it. Yeah. And it is certainly counterfactual that releasing a strategic petroleum reserve doesn't help when you have undersupply. It certainly helps, and it's a material percentage of the supply disruption. Is it 10%? Is it 30%? Somewhere in there, right? But still, it's much better than doing nothing. And so again, there was this weird narrative, don't do anything, it won't help, it's stupid, whatever. And there's a reality, which is, of course it helps. If you have a problem, they say if you're in a hole, the rule of holes, stop digging. And this is like, you're in a hole, don't start putting dirt in the hole to fill it, right? Of course you put dirt. You don't need to put all the dirt in. You can start with putting a little dirt in to fill it. So again, just a very weird, illogical, counterfactual set of arguments that people, I think, that should have known better fell into, I guess, because it's very exciting. And again, my thought into all this was that this would happen, right? I said a bunch of times, hey, there's these issues with Iran, there's this trajectory towards war, there's a risk of supply disruption, and I think that oil prices will go up over time, but you don't get a sort of skip steps there, and it feels like folks are sort of flipping from way too bearish to way too bullish, and I think there's room here to be bullish because of the long-term trends, and to understand the level of disruption, and to understand that there's a significant disruption on a day-to-day basis, right? There's this, let's say, 12 million barrels a day of supply disruption, but you need that to happen for a very long time before it cuts into reserves long enough and significantly enough to have a really big global economic impact.
Okay. Yeah. Yeah. Thanks for sharing that. Yeah, I was kind of thinking about this just a second ago. When Biden was releasing from the SPR, obviously they were looking to lower gas prices. They were trying to fight inflation. And I'm thinking about it from like a capitalist point of view in terms of like, okay, well, shouldn't the high prices, incentivize the companies to go out and produce more, and eventually, that resolves the issue of the high prices. It kind of just seemed like government involvement. Like, I don't know if the government should necessarily be involved in like releasing from the SPR, which is supposed to be like a critical mineral for like if we have to go into a time of war, we have like some major crisis or something, and instead let the markets handle the issue of the high prices. I'm curious in your thoughts on that.
Yeah, so I completely agree. I think that the start of the process to release the SPR at the start of the Russia-Ukraine war made sense because there was a risk that there were going to be supplies disrupted from Russia to the tune that we're seeing supplies disrupted right now via the Strait of Hormuz. And ironically, some of the same analysts and media outlets and whatever that were very opposed to the recent SPR release were very in favor of that SPR release in 2022. So again, there's like clear sort of incongruity and hypocrisy and so on, which is wild, right? When look back at what they were saying, it's crazy. So okay, so they were in favor of it then when it turned out there was only a couple million barrels a day of supply max disrupted in that sort of 2022 timeframe. And once it became clear it was 2 million and not 10 million disrupted, and that Europe and the US and others were going to be buying Russian oil, which again is very weird and cynical and whatever, to send Ukraine money and weapons, but then also send Russia money through buying. Europe was buying gas from Russia for the first year of the war. They were buying oil for many years into the war. So very weird and just
Yeah.
mind-boggling to even think about, right? But they did the release after it was clear. They actually went forward with it after it was clear that there was not a material oil supply disruption. And so they depleted these reserves that were there in case of emergency. And the emergency that they treated was the 2022 midterm elections here in the US. It was totally inappropriate. It was a terrible decision. They should not have done it. There was not the opportunity for a full market response. And that abbreviated market response led to a situation where you did see U.S. supply grow a little on the backside of that, but you didn't see as much supply growth as you probably should have. So you fast forward to now, you have less supply growth, like you were alluding to, and you have less oil in storage. And here we are in an emergency where the Strait of Hormuz is closed, which, by the way, is why we built the Strategic Petroleum Reserve in the first place. It was after the Iranian Revolution. It was after the supply disruptions from the OPEC embargo and the Iranian Revolution, and then the tanker war in the early 80s. And so or the mid 80s. And so this is what it was for. And unfortunately, it had been depleted on a bipartisan basis. This isn't all a bash Biden thing. And the Trump administration, I think, also is not doing itself favors through attacking the US oil industry over the last year, being very hostile, promising ultra low prices, encouraging drilling everywhere else in the world. Many different sort of systematic method, just continual attacks on the industry, which resulted in a much lower rig count in the US today than a year ago for drilling for oil. So yeah, there should be a market response to these sorts of things, but I do think that in this case, it is actually appropriate to pull oil from the SPR. And unfortunately, it's at a way lower level than it would have been had it not been for Biden pulling oil out of it, as well as a bipartisan sort of looting of the SPR to be able to cover up some budget deficits. Again, both parties over the last 20 plus years essentially looting the SPR, essentially stealing from us today in order to balance budgets, to some extent, basically wasting money on, in many cases, fraudulent government programs.
Yeah, for sure. They sure ain't balancing no budget, but they're definitely fraudulent government programs for sure. I'm curious your thoughts on this release of the sanctions on Russian oil. I heard that, and I was thinking like, does this mean I get my Luke Oil stock back or what? But I don't think the U.S. I don't know if we have plans to open those markets again. But just curious in your thoughts on the sanctioning, releasing the sanctions from Russian oil. I mean, I don't know if that's ever been in the discussion since the Russia-Ukraine war. If this is new, or if that's even a nothing burger, or if it's something serious. Just curious your thoughts.
Yeah, I mean that's moderate in terms of impact. Ukraine, it seems, has responded to that through directly attacking Russian oil export infrastructure and knocking a bunch of Russian oil export infrastructure offline, as well as attacking a LNG tanker. I think it's the first one ever to get blown up. They attacked early on in the U.S. and Israel war on Iran. That Ukraine, it looks like, blew up a LNG tanker in the Mediterranean carrying Russian LNG. So that's a complicated question. I
Yeah.
think the bigger question is, why is the US not sanctioning Iranian oil? And with Iran blocking the Strait of Hormuz, why has the US not seized all of these tankers taking Iranian oil out of the Strait of Hormuz to China and seized them as a part of this war effort, like the US did with Venezuelan oil when the US was replacing the regime in Venezuela, and then
Mhm.
sold it to our allies who were experiencing oil shortages of the sort that we were talking about earlier that have been all over the news. That to me is bizarre. There are claims that it's not really going to fund the Iranian war effort, which seem to just be fabrications because they say that, but then they also say, oh, the oil was pre-sold, so we can't take it. And it's like, well, which is it? If it was pre-sold, then it's certainly going to fund the war effort because the next cargo they'll pre-sell too. And so it's that to me, this idea is similar to the Russia war where Europe was buying Russian oil, but also funding Ukraine and sending weapons. I'm not saying they shouldn't have done one or the other, but doing both to me just seems wrong. And
Yeah.
to me, this also seems wrong. And the explanations have been contradictory and frankly unacceptable. So that's I was very critical of Biden before. Now I'm critical of the Trump administration for this particular aspect. Like, this does not make sense. If we're going to go bomb government buildings and assassinate government officials and attack military facilities in Iran, allowing the free flow of Iranian oil while other oil is blocked, rather than seizing that oil and then selling it into undersupplied markets of our allies, it just seems like an unforced error and a calculated unforced error, and the communications around it appear to be untrue.
Yeah, I never even thought of that. Like, why aren't we why aren't we seizing this oil that's going through the strait? They're like, hey, this is our strait now. We're gonna keep trading and keep the money flowing in while we fund our weapons or whatever. And yeah, that doesn't make sense to me. I didn't even think of that. So like, is this like new, or is this common, like where, well, I know that in like war, like previous wars, taking critical infrastructure, maybe they have like a weapons manufacturing plant, they would try to like cease that, or destroy it, and things like that. And in this one, in this situation, it seems like there's just a lot of wasteful destruction of like natural resources, infrastructure, and such. And I'm just like, like, what is going on here? It's pretty interesting. I'm still kind of trying to process like all of this destruction of like the natural resources that are to benefit the lives of billions of people. Especially even average citizens and such. And so yeah, it's kind of interesting.
Well, one comment on that. So there's been some weird claims that I've seen that attacking certain infrastructure in Iran is a war crime or something, which is actually sort of precisely as I understand it. I read there's this international lawyer who I follow who I actually met when I was at University of Chicago. He was teaching. He was a visiting law professor at the time when I was there, and he writes on this, and he's like, "This is like the complete opposite. A war crime would be going in intentionally, killing a whole bunch of civilians, but attacking like oil export facilities or key infrastructure. That's a part of a war. Wars unfortunately hurt people and kill people. That's just the nature of it. It's not in and of itself a war crime. And again, that's the same set. Like you can watch their news coverage and it's US or Israel war crime, and then it's also oil to 300. Okay, guys, like none of this is true. So why are you saying it? And then you just see people repeat it over and over again uncritically. And so unfortunately, as a part of war, there's terrible stuff that happens on both sides. This is a real problem, and wars are inherently humanitarian catastrophes. I'm not pro-war. That's nothing that I'm saying should be construed as that, but it's also, I think, important to be careful about what we say and how we analyze stuff, and to try to be very unpolitical and clear-sighted in terms of our analysis. And so I think, the attacks by the U.S. on Iranian energy infrastructure that's used to power Iran's war effort seems in line with military goals. Iran's attack on civilian population centers in Dubai, in suburbs of Tel Aviv, in Bahrain. I mean, that just seems very inappropriate and very different. And weirdly, you don't see the same sort of negative media coverage of those what look like intentional attacks by Iran on civilian areas and population centers as war crimes or whatever. But you do see it by those same media outlets on the U.S. and Israel, even where they're actually much more clearly, relatively speaking, pointed towards the military capacity and towards a successful culmination or whatever of the war.
Yeah, yeah. I guess it kind of boils down to like when the gloves are off, the gloves are off. I mean that's kind of what it seems like. Because I'm just thinking about it in terms of, okay, we all need these resources. I mean, even Ukraine, destroying the LNG tanker or whatnot, which, I mean, they've been in that conflict for 4 years now or whatnot. And I guess it's just to the point where it's like, okay, however you can hurt your enemy type of dynamic. And so yeah, that's kind of something that I'm taking away from that. So fundamentally, just as investors in the natural resource oil space, how are you looking at things fundamentally now? Outside of, right now we have a lot of signal noise type dynamic with the conflicts that are going on. How are you still looking at things fundamentally for the oil market?
Yeah, it's a great question. There's been very weird movements in the equity markets, which I guess you'd expect considering the very weird news stories and the very weird movements from a war perspective and the conflicting narratives on energy supplies and potential shortages and so on. So first of all, from an industry perspective, so I was at a breakfast this morning hosted by a great law firm that brings together a lot of different folks in land departments and various other groups at oil companies, and not one person was indicating an increase in activity by their company because of this conflict. There's no net uptick in drilling rigs right now for oil. And the reason, from what I can tell from their commentary, is that there's this expectation that the Trump administration and others will try to just push the price down as soon as possible, as effectively as possible, and that there's not that, as you were saying, economic market signal to go drill more. Because if the current price for oil is $30 higher than it was 2 months ago, but the forward curve is only $5 higher, that just wasn't, let's say, the price that you can get a year from now. If it takes you 6 months to bring a well on, it's just not enough of a price signal. And the price, frankly, was too low even $5, $5 lower was too low. The $5 increase for the forward curve for next year is also too low. And so there's just not that economic signal to go drill more. So what I'm finding interesting, and this may sound counterintuitive, is actually I do think there will be more drilling over time as people look at these markets more, understand the manipulation aspect of it more, where like the prices probably should be higher right now. Should they be $250 for WTI? No, but maybe oil should be 110 on its way towards 120, on its way towards 130 in this current supply constraint environment. And that should be signaling drilling more. So some of the drilling rig companies, as well as the other oil field services companies, some of them have not moved up much because there just haven't been more rigs being hired, which makes sense. People are waiting to see this. My view is that there will be more rigs used. So I'm very excited about those companies. And then from an oil producer perspective, you can tell that it's a very distorted market because some of the largest companies that were the least levered to an increase in oil prices have seen some of the largest share price movements. And then some companies that have a lot of debt have seen a similar percentage movement in their market cap and their share price as companies with no debt. But that's wrong because if you want to have them track appropriately, you'd want them to have a similar percentage change in their enterprise value, not their market cap. So you should see companies with a lot of debt trading up, let's say 3 times or 4 times, depending on how much debt they have, versus companies that had no debt or very little debt. And you're not seeing that uniformly across the space. So to me, it's been a great opportunity to sell things that have moved, in my view, too much. I have this newsletter. I put out a thing. I had a stock that, or it was a warrant actually, it went up almost 300%. It was like, this is great. This pricing, in my view, is wrong. There's extra risk from the war. I'll take this enormous gain and I'll move on. And at the same time, there's companies that probably should be up 3x and instead they're up 20%. And I'm buying those stocks with gains from multiple times return type setups like that. And so there's real mispricings right now. We saw this early on in the energy crisis in, let's say, 2021, similar sorts of mispricings. And it's really a fantastic environment, in my view, for active management in oil and gas to be able to sort of go find these mispricings, the rig companies ahead of getting more rigs running and ahead of improvements in margins, the producers where the stocks are just not moving the right way as people misunderstand them. Oh, there was one other one where there was this chart that was going around from this one analytics firm about how certain oil companies had more hedges in place and others had less. And they were directing people to go buy essentially the companies with less hedges in place, but they ignored that the companies that had hedges in place had them because they had more debt. So they were actually encouraging you, if you look at it per unit of share price, to buy companies that were net not as big beneficiaries, even after the hedging, and to avoid companies that were actually much bigger oil price beneficiaries, even with more hedging. So just for hedging is when a company locks in their forward sells a portion of their oil at a certain price. And so companies with, let's say, 50 or 60% of their oil locked in, but with a lot of debt, might actually, and with lower margins, might actually benefit more from that remaining, let's say, 40 or 50% of their oil experiencing a higher price versus companies with, let's say, no hedges, but at a much higher valuation or no debt, their benefit and, let's say, high margins from a higher oil price. So again, people are getting it in some cases precisely wrong, which is just a fantastic environment to be deploying capital.
Yeah, for sure. So speaking of deploying capital, I'm just curious in your thoughts on, so for me, I'm positioned in oil. I mean, I think probably only have a couple producers like Petrobras and I think some others, but I've been into the midstream companies for a while. Because they pay solid dividends, 7-8%. And then I've been into a little bit of offshore and some of the land royalties as well as royalty companies. Even Franco-Nevada, who's a gold and silver royalty company, has some oil royalties. And so there's so many ways that you can get exposure to to oil. And so I'm just curious in your thoughts on some of those kind of alternative ways to play oil.
Yeah. Okay. So I'll go through them sort of in the order that I remember. I don't think that the royalty companies are that interesting here. Weirdly, their stocks went up a lot, but their cash flow didn't go up a lot. They have very high margins, so their net relative beneficiaries obviously have higher prices, but not by nearly as much as producers who have much lower margins and experience much higher percent margin expansion. Also, the royalty companies tend to have very little debt, so they have very little financial leverage. So they have little operating leverage, little financial leverage, direct beneficiaries. But when I see the share price movements in some of these, especially sort of the more popular ones, they seem to have way overdone it. For example, also they've been very popular areas for people to deploy capital into. So that's one of the ones to me that's actually, I wasn't that excited about them before, and I'm super unexcited about them here at the valuations they've moved to. Similarly, midstream, where they to me, they're sort of these ticking time bombs where they have yields that they pay and people who invest in them, not based on the intrinsic value of the companies, but based on the dividend yield, let's say relative to bond prices or to treasury yields or whatever. And the problem is that these things are great and look sustainable and look inflation linked and all that until you get worried for whatever reason about the sustainability of those dividends. And historically, I've been a very large midstream investor at points where people are worried about either the continuity of dividends or even the solvency of those businesses. And those are amazing times to me to deploy capital in that space when people are treating them as oil proxies or gas proxies, especially treating them as if their distributions are safe and secure. To me, that's a great time to fully avoid that sector. I think I have zero midstream exposure right now, and I'm pretty happy with that. Refining is very interesting and complicated. I think there's a good argument there, but I have very little exposure there. Just the equities there have risen a lot, but that there's a good fundamental story for. And then the offshore drillers, there's some real risks. Actually, the thing I sold was a offshore driller related security, and they have a meaningful portion of their business in the Middle East, in the Persian Gulf, and that business has mostly either slowed down or stopped. And so the share price for that company is up a lot, but the run rate cash flow, again, will be determined whether or not they get paid these contracts and maybe they get standby rates instead of nothing. But there's a chance that their business contracted by 30% or 20% or whatever. And you can see it in some of the companies with very high exposure to the Middle East where they've had to re-guide way down on their revenues and cash flows. So not this particular one yet, but there's a real risk in my view of that happening. And so the stock is up a lot. These warrants were up even more, but the risk was also up, not down. And so to me, hey, will my original thesis play out? Maybe it would be great if it did. I figured it was a potential 10x or more at a up essentially 4x. It was great to cut it and be able to redeploy. So offshore, I think really company specific, but I'd be really careful about Persian Gulf risk, Middle East risk, because if this conflict goes on longer, which again, no one knows, but there is a risk that it goes on for a while, that to me seems like an identifiable and avoidable risk. And if I can find similar exposures like I have through onshore rig companies that could be beneficiaries of higher offshore day rates should eventually translate to higher onshore day rates because there's some economic competition between those two. So if I'm right on that original thesis, let's say 2 years from now, there's no more war. Hopefully there's no more supply disruption, but the offshore rig market's tight. Rig rates are higher. I would have made a lot of money on those warrants. Wonderful. I think in that scenario, I will have made a lot of money on the onshore rig companies that I've been adding to very recently.
Okay, got it. Yeah, thanks for sharing that perspective. So just as we wrap up, what are some of our investors that watch this show, they're mostly into the metals and the miners and such. What are some ways that they can learn about? I mean, oil is a natural resource. It's like it's a cornerstone to the global economy and such, and it's also massive, right? It's also a massive industry. And so, curious in your thoughts on what new investors could do to learn more about investing in this particular sector? And then also, I would love for you to plug Bison Insights, your newsletter that you put out for subscribers.
Well, I was going to plug it as an answer. I think it's really hard and complicated to understand what's going on. I think there's a lot of biases. I was chatting with a friend at this breakfast who pushed back on me and said, "Hey, well, you're upset about these media companies misrepresenting stuff, but you're biased. You have economic exposure in the sector." And my response was, "Hey, where I've been very bullish natural gas, for example, I've built positions and I've shared my view that I'm bullish on that sector and on certain positions in the sector. And where I've been bearish on natural gas, I've shared that view and I've cut back a lot on my exposure. Similarly, I think we're in a multi-year bull market setup for oil and oil producers and services companies where I no longer think that. I will sell those and I will be very public, probably to much chagrin, maybe even more pushback. When I've sold companies that are very popular, I get crazy amounts of pushback for having sold them or being negative on them or whatever. So I imagine that I'll get even more pushback for that as I've gotten for being bullish on oil and right. At a time when almost every pundit, every podcast guest, every TV guest, whatever, was very bearish. So I think it's important to sort of look through with clear eyes at these things. And I haven't found great resources for that. So I created one, which was a newsletter. It's called Bison Insights. And I share both macro analysis that I think matters. It's not comprehensive. I just try to find what matters, where my view is a variant view, and I try to explain why. And then I share stock ideas of companies and related securities that I own that I think are particularly interesting. And again, there's an inherent bias because I own them, but I don't own them to talk about them. I own them because I think that they're really attractive and have asymmetric risk reward. And I will be wrong, and I've been wrong before, but the ideas I've shared have done sort of extraordinarily, like they've done so well that the next 12, I've shared 12 ideas, they will certainly do worse than the last 12 because there's no way that they can do better. They've just done so, which again is great, but also just to set expectations. So I set it up because again, it's really hard to figure this stuff out. It's really hard to really understand what's going on in the space. And unfortunately, the loudest voices for the most part, the folks that are easy to access, their views that are easy to access are almost always wrong. And they're sort of dangerously, confidently wrong. And in many cases, they also don't have their own skin in the game where they're not expressing their views via betting on it in a way that's meaningful to their personal net worth. And I am, and I think that's a big advantage in that space.
Yeah. Thanks for sharing that. Well, Josh, appreciate you for coming on the show. I've always learned something new every time you come on, so I'm always grateful for your time. Thank you, you all for watching. Be sure to hit the subscribe button if you haven't subscribed yet. We're on the road to 100,000 subscribers, so be sure to hit that subscribe button. And until next time, Josh.